Hello, and welcome to our presentation on an economic threat analysis of Adidas and how that is impacting their profitability, but how the company has the chance to turn it into a competitive advantage in the industry. My name is Erin, and I'm joined by Kyle, Alex, Olivia, and Luna, and we will be focusing on the import tariffs put in place by the US against key Adidas suppliers. All right, to start off, what is the issue? Adidas is facing a projected €400 million reduction in operating profit due to these US tariffs. At the start of the year, the company announced their projected profits of the year to be €2.3 billion, which is about a 15% shortfall of the €2.7 billion estimation from market experts. This is driven by heavy reliance on Vietnam and Indonesia to produce a multitude of their products, exposing the company to those rising import costs. In an attempt to retain their market share, Adidas is aiming to keep product prices low despite rising costs from the tariffs, which leads them to the major drop in operating profit. From Adidas's 2025 annual report, this graph illustrates the distribution of manufacturing efforts across many countries in Asia. Especially in their footwear line, we see majority of that manufacturing taking place in Indonesia and Vietnam at a combined 72%. It's also important to note that China plays a key role in distributing goods in every product category that Adidas specializes in. You can see below that Vietnam faces a 20% tariff on goods sent to the US, along with China at 10% and Indonesia at 19%, which puts into perspective the profitability risk that Adidas faces with these distributors.
So, why should Adidas care? There are three reasons as to why we should care, and they all hit the bottom line directly. The first reason is margin compression. The tariffs we're seeing on our goods being manufactured in Vietnam and China are eating into our operating margins in a meaningful way. As the chart shows, Adidas is already projected to fall short of its 10% midterm target, landing around 8.5% in 2026. That's roughly a €400 million profit reduction for the year. Secondly, it's a strategic timing risk. The 2026 World Cup is upon us, and it's one of the biggest revenue opportunities in Adidas' calendar. Manufacturing disruptions could not come at a worse time. You can't capitalize on peak demand if your supply chain is under pressure. The third reason is a competitive disadvantage. While Adidas is absorbing these costs, Nike and our other competitors who have a more diversified or domestic manufacturing are less exposed. Every dollar we spend managing the tariff impact is a dollar not spent on our innovation or marketing. The bottom line is that it is not an abstract supply chain issue. It's a direct threat to our profitability, strategic execution, and competitive position, all at once.
So, what does this actually mean for Adidas? This isn't just a cost issue, it's a strategic risk. We're already seeing the market react with Adidas stock dropping about 7% following this uncertainty in late February. That signals declining investor confidence. If these tariffs continue to pressure margins, Adidas will have less flexibility to invest in marketing, innovation, and growth, which are critical in such a competitive industry. At the same time, long supply chains from Asia limit their ability to respond quickly to demand spikes, especially with major events like the World Cup. Adidas also risks losing market share to Nike. Nike's more flexible supply chain allows it to respond faster and manage costs more efficiently. If Adidas faces higher tariffs, it may be forced to raise prices or accept lower margins, pulling it through a competitive disadvantage. Nike controls roughly 44% of the global athletic apparel market compared to Adidas at about 25%, highlighting a significant competitive gap. Ultimately, if no action is taken, Adidas risks falling behind competitors and losing market share during one of its most important growth periods.
Now, after analyzing the decline of Adidas stock, we've come up with a viable solution. We recommend a regional hub strategy. shifting final assembly to Mexico using a semi-knockdown production. This would allow Adidas to gain leverage of the USMCA's rules and significantly reduce tariffs, bringing tariffs down from a whopping 20% down potentially to 5 or possibly even 0. Additionally, creating a currency hedge by shifting cost base in Mexican pesos. All of this would eventually lower logistical costs as well as improve supply chain flexibility, reducing these delivery times that were used to be at 6 weeks down to 3 to 5 business days, improving responsiveness to World Cup demand spikes, adequately accommodating to the high operating costs Adidas is dealing with right now.
Now, while we believe that Mexico have a strategy is a strong response to this challenge, we also want to be transparent with the limitations. The first limitation is around the USMCA's rules of origin. For Adidas, to get the tariff benefit, at least 55% of the product's value needs to come from work done in North America. If the assembly in Mexico doesn't meet the number, the production is still treated as made in Vietnam, and the Adidas will still face in the full tariffs, so getting the threshold right is critical. The second challenge is Mexico's own tariffs. Mexico charged a 35% tariff on products coming in from Asia. So, the parts that Adidas ship from Vietnam or Indonesia to Mexico would already face extra costs before even being assembled. That adds up and it needs to be factored into the financial plan. And lastly, there are real operational challenges. Setting up a new production hub takes time, money, and planning. It's not something that happens quickly. It requires building supply relationships, training workers, and phase rollouts. There's a real obstacle, but they don't make the strategy unworkable. They just mean Adidas needs to go in with a clear plan. In summary, what? Adidas expects a 400 million drop in its operating profit due to US tariff imposed on its main manufacturing countries, Vietnam, Indonesia, and China. Why? This goes beyond costs. Adidas is already seeing its stock price fall and investor confidence wane, and the risk of falling even further behind Nike is very real, especially with the World Cup approaching. How? We recommend shifting part of production to Mexico to take advantage of the USMCA, reduce delivery times, and make the supply chain more flexible. Yes, there's a challenge to achieving this, but the long-term benefits make it worth the effort. The time acts is now. Adidas has everything it needs to remain competitive, but it must act quickly.